Hello, everyone. I am with two students, a master in financial engineering student, Ramos Wu and Jack Dean. Um, I thought it makes sense for us to talk about a salient topic, Robinhood, the hedge funds, GameStop. I'm sure anybody that understands that's in finance wants to know what's going on, and them and all and the entire team was a buzz with comments and what's going on. I figured let's do a podcast. Let's talk about it. What happened first of all. This relationship between the small investor and the hedge funds. I mean, the GameStop stock went up at almost tenfold. I mean, intrinsic value will tell you this thing is not worth anything, but obviously somebody's paying for it. Is there something else going on? Jack will talk to us also about the plumbing, the relationship, the interrelationship, the connectivity, and how this actually works. And then we'll finish talking about the regulations. Do we need to do anything, or we just let it be? So, Ramos, why don't you launch it and you
Yeah,
start?
so thank you, Professor, for inviting me into this. So I guess I can provide some basic background about what happened. So there is a forum called the Wall Street Bets. Normally, people are just screaming about what kind of crazy trades they're doing. You know, some of them make millions of dollars overnight, and some of them basically lose their whole life saving overnight. And it's a lot of crazy stuff happening. So I guess in Wall Street Bets, this forum, a lot of people has seen that GameStop has been struggling, even with COVID. A lot of people are trying to buy consoles, and they also found out that a lot of the institutional traders and the big hedge funds are short selling the stock. So they're just screaming and trying to get everyone to prop up the price. So almost 200 millions of the traders in Wall Street Bets, this forum on Reddit, all decided to buy GameStop, and which prop up the price for about 10 times, as Professor just mentioned. And after that, Robinhood decided to block all the buying from these retail investors, and that kind of created a controversy. And so that's basically what happened. And also, no, not only they targeted GameStop, but after that there was Nokia, BlackBerry, AMC. These stock has been struggling for years now, and then somehow they're all up around 5 to 10 times as what their
And
true
that's the
value
thing, right?
is.
I mean, all
Yeah,
these stocks were not doing well. I mean,
they weren't.
GameStop as a retailer. Wow, when was the last time you go into one of those stores? But this idea that they all got together and say, okay, let's quote unquote prop up this stock for good or bad
Yeah,
reason.
and then the thing is that it creates a lot of controversy. A lot of people are not happy with this, with what they're doing, because they're basically, you can say they're really manipulating or screwing the market. But also, this kind of trades by that 200 million people on Reddit, it's all based on speculation. They don't have any insider informations, and what they're doing is completely legal. So whether or not Robinhood decided to block these traders from trading that specific 6 to 8 stocks, I think it's something that we can really discuss about.
Jack?
I think the key thing to understand with GameStop is the reason the effect was so strong is because of its short interest. There was 100, I think I had it at 102 or 103% short interest. So we saw the short squeeze, which, we've seen it before. Essentially, when something's over shorted and you get a lot of buy actions, all of a sudden the price skyrockets. It's this weird market condition. That's why the GameStop thing was a little bit more, you know, seen than some of these other names, but they're all kind of named. They're all kind of you can see the effect that Robinhood, well, the retail traders, or the technical term they call themselves on Wall Street Bets is YOLO investors, which is kind of funny, just because it's literally betting, and like that's how people are looking at it. And part of the way they're taking these positions, and this is what's interesting to me, right, is like the retail trader has always been there, played in the equity markets, bought stocks low, sold high, the typical way that, an investor invests. But the new thing now, like everyone thinks they're an options trader now. Like everyone is, taking these naked option positions on these names. Like there was one Reddit user who the journal actually did a profile on the guy. He was up $50 million at one point on naked option trades on GameStop. And to be clear, he made this position over a year ago too. So like he kind of like saw, I mean, I don't know if he saw something coming or he just has a good feel for it, but like it wasn't like a small position. It was a $50,000 position he had a year ago, and he ended up being up 50 million, and then he lost 15 million the next day. So it's funny. I say it's funny to see it. It's funny to see it because it's not conventionally done that way. The way that most of us as finance students are taught how to trade these derivatives. So yeah, it's an interesting time, to say the least. And there's some plumbing issues that go into it that I think cause some of the issues that we saw that I don't think everyone's understanding. So, I was going to go into that a little bit.
Yeah, let's do it.
So,
Let's do it.
Yeah. So the key thing there to understand is Robinhood's a brokerage, right? They're like E-Trade, they're like Schwab. They're essentially allowing their clients to say, hey, I want to take this position. And then Robinhood has to go to a dealer or a market maker and say, okay, like I have a customer that wants to make this trade. I need a position on this. And the market maker quotes them a market, and, the trade happens and the person owns their stock, whatever. And that's how this industry has worked. But as the industry has, become more and more run by shifted to embrace technology, right? Because you used to have, traders in pits wearing funny jackets, making hand signals, yelling at each other to take positions. And, you either had to go to the New York Stock Exchange or NASDAQ or the Chicago Board of Trade or the Chicago Options Exchange to make these positions. But now, as things have become digitized, right, these exchanges are no longer on the pits and they're in these data centers, right? And there's more of them. I think it's like 17 current public exchanges, right, where this stuff happens. But then in addition to that, and this is where things get convoluted with these retail trades, is you have these dark pools, which are essentially off the books exchanges. And that's where a lot of these trades take place on the equity markets, to be clear, for these brokerage. So to give you an example, right, if you place a trade on Robinhood, right, you'll say what your trade is. Robinhood then reaches out to the market maker. So the key market maker for Robinhood is Citadel Securities, to be specific, right? There's a lot of Citadels. They all fall under one Citadel, but Citadel Securities is the key market maker. And to give you an idea of their size, they touch 40% of all stock trades, right? They're on one side or another of 40% of all trades, apparently, which is kind of crazy to think about it. That's a lot of volume, right? And what happens is Citadel makes a market for Robinhood. Robinhood executes the trade happens. And this might happen on an exchange. It might happen in a dark pool. The obligation of the broker is what's called best price, which if you read dark pools, Michael Lewis goes really into how this stuff works. Doesn't necessarily work out. Robinhood actually got slapped with a $65 million lawsuit that they settled. I think it was last year on something with this issue, who they've said they fixed. It's kind of hard to understand because you have to really go into, how this stuff works to know if that's how it's fixed. But generally that's how it works. And then the trade's registered with a clearinghouse. Robinhood has to post a collateral until the trade clears. These are typically how this would work. But the problem is, like, the collateral that they're posting is a multiplier of the volatility of the name being traded or of the market. And because GameStop became so volatile, because so many people were trying to pile into it, the volatility multiplier went up astronomically. And all of a sudden, Robinhood was being asked to post billions of dollars in collateral that they couldn't do. And in 3 days, they raised $3.4 billion so they could allow trading on these names while they had paused position openings, which is an astronomical number. It's more than they had raised as a company in their entire existence.
So that's something that I guess like the insiders or like people who has more knowledge of like what is really going on would know. So the thing is, what you have said about that one person on Reddit, Wall Street Bets, putting a $50,000 naked trade and end up getting $50 million, and then for the past 2-3 weeks, I got multiple phone calls and just people asking me, hey, can you buy 100 shares of GameStop for me? And then, so I guess like people around us, like common traders or like people who has zero to limited knowledge, they're all trying to get rich quick. They're all trying to get in as soon as possible and trying to get something out of it. And I guess that's what the Robinhood was saying. They released a statement saying that they're trying to protect people. They're trying to protect these people. So that's the reason they're blocking the trade. So what you're saying that it's actually they're not trying to protect the retail investor, but rather themselves because of the collateral they have to be paying?
I mean, in my opinion, and this could be construed as controversial. In my opinion, if they wanted to protect the trader, they'd allow them to play in the equity space and they wouldn't allow them to play in the derivative space, because that's where the bet concept comes in. And that's where you have guys losing crazy amounts of money in a very short amount of time.
It's a leverage that's playing in, right? Because you mentioned gambling, right? The difference between investing and gambling is that with gambling, when we used to trade credit default swaps, well, you never own the asset, so you're betting on the situation on the movement with no intention of owning the asset,
Right.
or not even owning the asset. So that's gambling, right? When you invest, you have to have something to invest. You have your cash and you get a share or a bond or something. Here, feels to me that this is purely ether and speculation, and and aided by what? What aided this? Is the what was the spark? I guess the fact that you could now, on now it's a lot easier to do it, right, than before, because you have to go in the pits. Now you don't go in the pits.
It's a lot
literally.
easier, and I feel like it's a lot easier, which makes it a very scary, because like I remember that one day GameStop was up by about like more than 100%. Then the next day they lost like 50%. And I guess like that's normal just because the volatility that's with GameStop stock. But what happened to those people who has limited savings and literally just trying to get rich overnight, trying to buy in and get out tomorrow? So how can people really protect, how can I guess regulators or these brokerage really protect people from making these crazy bets? Because a lot of things, because this sounds like betting to me instead of investing. Because
Jack,
right
is that
now,
what they were doing? They were trying to protect? You
Their
saying
that's
no?
what they
statement
claim they said.
was, we have halted position opening on these 10 names, GME, BBY, AMC, to name a few, right? Because they wanted to protect their clients, i.e. their traders, and the firm, which is a couple things going on there to me, right? So in addition to that statement, they also withdrew $100+ million from the revolving line of credit. They raised $900 million overnight. The next 3 days, they raised another $2.4 billion, right? To me, and this is just conventional, to me, this is conventional security analysis. Whenever a firm withdraws their line of credit and they put out anything that says, and to protect the firm, they have a liquidity crisis. That's how I've interpreted it.
That sounds right. Yeah.
And I don't mean to say, and Vlad Tenev, CEO of Robinhood, was on CNBC and he said, we don't have a liquidity crisis, but then said that, right? Which Andrew Ross Sorkin was interviewing. I give him a lot of credit because he said, yeah, but that sounds like you have a liquidity crisis, right? And to me, that's what that says. I don't really like it's hard to say because they're not a public company and you can't just look at their financials, but everything's pointing that way. It's as someone that's done some basic security analysis before. I mean, I don't know if you have another way of looking at that, Professor, but
Yeah.
that's how I would interpret it.
Well, whenever you draw on a revolver, right? Well, I guess as long as you repay it by the end of the year. But so where do they stand now? I mean, because they got lots of money. I mean, people, they were able to raise lots of cash.
Well, the thing is, as long as they have users, Robinhood will make money.
Mhm.
The interesting like business model that goes on with these brokerage, retail trader brokerage services is this thing called payment for order flow, which is this concept. It's actually established by Bernie Madoff, the same Bernie Madoff you're thinking of, the Ponzi scheme. Yeah,
Stop.
this is the guy that came up with this system.
Oops.
Yeah, where the market maker, who they're capturing a bid ask spread, right? That's their P&L. Will pay the brokerage service to execute trades. So in this case, like Robinhood made the most. I wrote this down because I was reading this earlier.
Yeah. Please.
Robinhood makes the most out of these brokerage services, and they received 23 cents per 100 shares traded on the equity markets and 62 cents per 100 options contracts traded in derivative markets. For
And the
the
average,
trades, because
is
the market
25.
makers, not exact, that's just what I got from the Financial Times. But what you're saying, the average was 50 cents.
The average
per
is around 50
option
cents.
contract?
So yeah, so it seems like what they're really getting from the Wall Street, and they're really trying to protect Robinhood. It seems like that.
Well, what's happening is the market maker, as long as there's a positive bid ask spread, will always make money, right? And the reason that this payment for order flow was put in was because at the time, market makers were trading and they were quoting things in eighths as opposed to in decimals. So there was a large bid ask spread that they were capturing, which of course the decimalization makes it smaller. And then they're also saying, oh, the market makers are making so much money because they're executing all these trades. The volume's gone way up with high frequency trading and whatever. So they said, okay, brokerages are going to get paid by the market maker, which is going to cut into the market maker's profit, which is good for the retail investor in a way, because then the retail investor has no commission.
Mm-hmm.
So it doesn't cost you $5 to place a trade, right? It now is, oh, I can trade for free on my own account. Great. And this is how Robinhood makes money. So Robinhood will always, as long as there's customers, they'll always make money. And then the market makers, as long as there's order flow, they'll always make money. So it becomes an interesting question.
Hey, Jack.
Yeah.
You know, it's like the casino business, right?
Yeah.
Yeah.
As long as people come in, we'll make money.
Mm-hmm.
Exactly.
The name
And
of the game is to bring the people in the casino, because we'll make
Yes.
money whenever they're in the casino.
Pretty much. Yep. That's how this one works.
Yeah, and then
that's interesting on regulation, because on Capitol Hill, they're calling for this payment for order flow system is wrong and it needs to be regulated. And it's like, all right, like I see that side of it, because payment for order flow is kind of what got us into this mess in a way. But at the same time, it's like, well, commission-free trading is also pretty cool. So I don't know. It's a tough one. So
it just really seems to me that like what Robinhood and the other brokers blocking the buy order for the trade, kind of jeopardizing the honesty and the reliability of the free market that people are saying. So what is your take on what's the better, I guess, like regulation, or is there anything that can really protect the clients, also protecting the firms being traded and these brokers? Like, is there a way that we can really create a reliable and free market?
So this is the thing, right? In high levels of volatility, the market has systems to halt trading, right? So it used to be for NYSE, the specialists could at their own discretion say, okay, we're halting trading until we can catch up, right? And now you have circuit breakers in that say, okay, like we've hit this whatever volume metric or whatever volatility metric, we're halting trading, right? Now it becomes, because the exchanges, right, are no longer just, these 4 exchanges in the country, right? Now there's 17 of them, plus there's 44 dark pools, that exist, right? There's no way you can say, oh, we're halting trading, because, you could, if you can't get, your NYSE stock on the New York Stock Exchange, you can go over to NASDAQ and get it. Like you can trade on multiple exchanges, right? So it's tough to do because it's decentralizing, if you will. So there's no way to say, oh, halt, done, we're not doing this right now. and this is the thing that, like, when Robinhood said we're going to halt trading, like, one, they had to do it. They couldn't post the collateral required in the clearinghouse, is how I've interpreted it. But like, in addition to that, it's the only way retail traders had access to trade was Robinhood, E-Trade, or Schwab. And you can't just go open these accounts. It takes 2 days for your funds to clear to go trade it. So you can't be like, oh, let me go over to the other exchange like a prop trader could. You know, a prop trader, oh, I can't get it here. I can't get it on NASDAQ. I'll go over to BATS. You know, like it doesn't work the same way for the retail investor, because the retail investor doesn't have access.
We had the problem with the credit default swap, right? That thing was larger than the stock market,
Right.
even though it was in the dark web. It was bilateral kind of agreements, but it was larger. So then this whole thing collapsed. We know what happened in 2008. I know because I was there. So then they came in and they said, okay, you know, we need you need a trading, you need a clearing house, right? So, which you have in this case. But what you don't have, and what you're saying is, you can't stop it.
Yep, that's the problem.
But what if there's a way that you know, that like we can kind of regulate? I guess that kind of go against the free market. But like from what I've known is that, yeah, it takes 2 to 3 days to open an account, but also opening an account, it's really easy, and it's the retail traders making that, like, causing this craziness, and also kind of aiding to this crazy. So is there really a way that we cannot like stop it? So we just let it flow? Because I know that, like,
You can't let it flow. That's
because my take is right now,
like, we've seen what happens when you let it flow. You get the flash crash. You know, like when you see, like, one bot sees one thing and goes, oh, hey, I got to get out of this. And then it gets out, and then the other bot sees it. And then all of a sudden you've got the widest bid ask spreads we've ever seen. You can't execute trades. Like, there's no way you can effectively do it. I guess the best way we've seen was in Black Monday in '87, when market makers just didn't answer their phones. But then, like, that's a problem, because, you know, people are still trading in some way. People are still trading. The insiders are still trading in some way or another. And it's just, it would be almost impossible to regulate, in my eyes, with that kind of thing.
It looks like it's almost like a warning, because you're right. And that question was brought by Ramos, right? Yeah, I mean, it's great because prices are going up. So, oh my God, how much money am I making? Oh, you prevented me from making more money. But what about if it goes the other way around?
So yeah, so it seems to me that, like, all the volatility starts from the retailer investors. It all starts from there.
Yes and no. The retail investors increased volatility, but there's broader market conditions that are affecting it too. Like, it's tough to say, because it's, you know, it's kind of, it's tough to say. Like, I wouldn't say, like, oh, the volatility is just because of the retail trader, but you know, that's just a broader market condition. Like, it depends on who's interacting. I wouldn't say it's just because of they're a factor, no doubt, but I wouldn't say it's just them.
Yeah, they're definitely a factor, also the spark of, like, why is this happening? So I guess the whole issue, it's more systematic. It's all across the whole financial market.
Well, yeah, it's, how do you deal with volatility is a question that the market.
So what about the regulations? What are they going to do for regulation? What could they do?
I don't. That's a tough one. I mean, in the wake of the crash in '87, market makers were required to honor quotes. You couldn't just not answer. Was their solution there? And then, you know, later on, you get this best price thing that came out, which was or was not good, depending on your viewpoint. You can read up on that. A couple years later. I mean, now I think if you really wanted to regulate it, you have to find a way to control trading of names across exchanges. And that includes the off the books exchanges, the dark pools, for instance, right? That such that you know exactly how something's acting, and it's not just like, oh, it's whatever. But then that begs the question of like, well, is the market, does that add more imperfections to the market or more perfections to the market? Like it's tough to say, because like, you know, no one can really understand like, okay, this is how the market is operating, because the market is so complex as time has gone
Yeah.
on. So it's,
And
it's
you know,
really,
you brought up 1987, and so the market dropped 20% in one day. You know, Robert Schiller did a survey right after that, right? He sent out very famous survey, and he sent out to 1,000 people. I mean, you know, people in the market, and say, hey, what did you sell on that day? And it's documented that his paper basically says that, well, there was no really one single event that caused it. So when I hear this, and I hear the discussion about, okay, we're going up, great. What about, you know, if this thing heads south, what's going to happen? And because we don't really know what causes stock market crashes, like we know, we kind of know when it's happening, but we don't understand them, because it's, you know, in 87, it certainly didn't. And it was one of the largest, if not the largest, percentage wise. This could be a warning, right? And maybe that's why Yellen and the Fed is getting involved in terms of trying to, quote unquote, regulate this. I don't know, maybe we're back for another podcast 2 weeks from now where the market crashes because of the fact that, you know,
well,
we don't understand it.
it's easy to see it. It's very easy to be a bear right now, because you know, the Fed has pumped up the market into this massive bubble. A lot of people would argue. And, you know, this is one of those things that like the crash happens when fear overtakes greed. And a lot of people had a lot of fear when they saw what the retail trader could do. And, you know, I was kind of saying like, this could be down in the next, if not tomorrow, the next few weeks. Like, this is probably not good for the market as a whole.
Yeah.
Regarding its performance. Not necessarily, it's not good to have the retail trader involved. Retail trader should be involved in the market. It's their money, they're entitled to be involved. But for the market condition as a whole, it could be an issue, the way it's operated right now.
Very good. So I think we'll, Ramos, any parting comments or?
Yeah, I was just agreed on what Jack was saying, because you know, fear, it's more than greed. And then we tend to know that a lot of retail traders, or you know, just common people that, you know, you see in a CVS, they're probably trading too. But we know that like the retail traders, I read the number is only about 14 to 15%. So yeah, they could be doing a lot of crazy actions. They could be panicking and panic selling that cause some. But I guess the whole thing, and in terms of regulating and also how the market is moving, is still mainly on the hand of institutional traders. So I guess we will have to see what the SEC and all the Fed, what their action is going to be, because this is something scary. Yeah.
Let's wait and see what they say, and then we'll be back and for part 2 of this interesting discussion.
Okay. Thank you.
Sounds
guys.
good.
Thank you very much.
Thank you so much. Have a good day.
Jack, thanks.